All right, let's dive in. Today, we're going to decode one of the most common, yet, often misunderstood tools for investors, the price to earnings ratio. You've probably seen it called the PE ratio. We're going to make sense of the numbers together. So here's how we're going to tackle this. First, what even is the PE ratio? Then we'll see it in action, so it's not just theory. After that, we'll figure out how to interpret the number, understand why comparison is so critical, and finally, wrap it all up with how to think of it as a tool, not the final word. The world of investing can feel like you're just drowning in a sea of numbers and jargon, right? Well, the PE ratio is a really great way to cut right through all that noise and get a quick read on what the market is thinking about a company. Yeah, if you've ever looked at a stock quote and just felt your eyes glaze over, you are definitely in the right place. We're about to turn that confusion into confidence, and we're going to start with this one core idea. So, what is it really? The PE ratio is like a bedrock of stock analysis. It's super simple. It just takes the company's current stock price and compares it to its earnings, specifically something called earnings per share. Okay, if you remember one thing from this whole explainer, make it this. This is the absolute best way to think about it. The PE ratio is literally telling you how many bucks investors are willing to fork over for just $1 of a company's profit. It's basically the price tag the market has slapped on a company's ability to make money. And just so we're crystal clear, that E in PE, it comes from this number, earnings per share, or EPS. All that means is you take the company's total profit, you divide it by all the shares out there, and boom, that's the little slice of profit for each single share of stock. Theory is great and all, but this stuff really clicks when you see it work. So let's get our hands dirty and walk through a really simple, practical example. Let's meet our made-up company, Techstart Corp. Right now, its stock is trading at $50 a share, and its earnings per share is $2.50. The math could not be easier. You just divide the price by the earnings. 50 divided by 250, and that gives us 20. Okay, there's our number. But so what? What does 20 actually tell us? What's the real story here? It means that for every single dollar that Techstart Corp makes in profit for the year, the market, investors just like you, are willing to pay $20 to own a piece of that profit. See, we're right back to that price tag analogy. It's a direct window into what the market expects from this company. So, is 20 a good number? Is it a bad number? Well, here's the thing. A PE ratio all by itself is pretty much useless. It doesn't mean anything in a vacuum. Its real power comes when you start to understand what a high number or a low number might be trying to tell you. Okay, on one hand, a high PE usually means the market has huge expectations. People are betting on massive future growth, which you see all the time with tech or biotech companies. The risk, of course, is that if that amazing growth doesn't actually happen, the stock could get hammered. On the other hand, a low PE might be a sign of a hidden gem, an undervalued stock just waiting to be discovered. But you gotta be careful, it could also be what they call a value trap, a company that's cheap for a very good reason, like its business is heading for a cliff. And this brings us to what is maybe the most important rule of all with PE ratios. Context is everything. To make this number actually useful, you absolutely have to compare it to the right things. And there are three main comparisons you want to make. First, how does our company's PE stack up against its direct competitors? This is so important because a PE of 20 could be totally normal for a tech company, but insanely high for, say, a boring old utility company. Second, you gotta look at its own history. Is 20 high or low for this specific company? And third, zoom out and compare it to the whole market, like the S&P 500. Each one of these gives you a totally different and really valuable piece of the puzzle. Now, just when you thought you had it all figured out, there's one more little wrinkle we need to iron out. That E for earnings? Well, you can look at it in two ways. You can look backward, or you can look forward. So the trailing PE uses the real, actual earnings from the last year. It's a fact. It's reliable. But, well, it's in the rearview mirror. Then you have the forward PE, which uses estimates of what analysts think the company will earn in the next year. This is great because investing is all about the future, right? The catch is, those estimates can and often are wrong. The smartest investors, they look at both to get the full story. So, after all that, what's the bottom line here? Let's tie this all together with the most important thing to remember. At the end of the day, the PE ratio is not some magic number that tells you to buy or sell. It's not a verdict. Think of it more like a really powerful filter.
It's an amazing first step to quickly see what the market thinks and to find companies that might be worth a closer look. But please, never make it the only reason you make a decision. It's just one important piece of a much, much bigger puzzle.
So the next time you're looking at a stock and you see that little PE ratio sitting next to the price, you'll know exactly what you're looking at. It's not just some random number anymore. It's the beginning of a story about expectations, about risk, about growth, and about value. The only question is, what story is it going to be telling you?